Hey YouTube, welcome back to the Jameson Brandon channel where we talk about all things money. Today we're going to zoom out a little bit, that's right, zoom out, and we're going to look at the macro. We're going to look at really what's going on and fueling a lot of the inflation that we're seeing, which does affect the stock market, it affects your crypto positions, it affects the groceries that you buy, the wood, the lumber, all those things. And it's really a narrative and a story that we've been covering over the last couple months as it's been happening over in Empire Alerts. So let me just take these off so I can kind of hear myself here. And this is paid, by the way. It's $1 a day. And yeah, it's really, really good. That's what people are saying. And what we cover is we cover all the macro stuff. And that dovetails into crypto and your stock positions more than it ever did before. So I want to talk about inflation a little bit. I want to talk about what the Fed has been doing, money supply, show you some data, show you some charts across 3 different emails that I've sent out over the last week or so, and kind of catch you up if you aren't getting these daily from us. Okay, so let's start with what is mounting. So it's interesting, data you get sometimes is very, very skewed. It's very, not skewed rather, but it's old. It's interesting because data you get sometimes is very dated in terms of when you get it and what it's talking about. It's talking about last quarter, but we're in a new quarter and things do tend to change that much. So I'm going to share with you 2 sides of this narrative and this story here because they really do conflict each other. And one is talking about like what's essentially happening right now, and one's talking about what was happening in the first quarter up until about March. So what's happening now is there's a record high amount of shorting going on in Tesla, and it started around March, I want to say, but Michael Burry, Scion Capital, I think, the big short guy from the movie, has definitely been the most vocal, coming out saying that he's now taken, besides the smaller position, he's now taken out a $530 million short against Tesla. And really the big concern that he has is that it's living off of government money, essentially, for different green programs that they're involved in, and outside of that, they wouldn't really be profiting that well. I've shared with you guys about what's going on with Tesla in China. It's not really doing that well, and understand that this is up until like mid-May. When did I send this? This is the 18th. So again, this is like 10 days old now. So, okay, what I wanted to share about here is according to Goldman Prime, really just what's going on with hedge funds and where they're at right now, because then I'm going to share some data with you that was up until March. They were all long, but now apparently they're all short. That's the short of it. Okay, so according to Goldman Prime, there's the biggest shorting of tech stocks in the last 5 years by hedge funds going on right now. When did I send this out? Yeah, again, the 18th. And so this data is fairly recent. It would definitely mark quarter 2 for sure. And so, all right, was net sold for the first time in 3 weeks, driven by short sales outpacing long buys 2.4 to 1. And it's mostly been tech. As noted previously, however, the real action is in the tech sector. GPS Prime noting that Infotech was net sold for the 4th straight week and saw the largest net selling in more than 5 years, driven entirely by short sales. Okay, the sector has increased shorting in the past 4 of 5 weeks, 8 of the past 10, which is in contrast to long flows, which have seen buying 7 out of the last 10 weeks. So short to long flow, we've seen a huge shift in narrative happening here as May starts. So we've also seen there's some corresponding story with this. Billionaires and insiders, not billionaires, but insiders, C-level insiders have been cashing out. A lot of position sizing is being cashed out right now. So this is just more data. I'll keep this up on the screen for a second. Hedge funds are now UW Infotech stocks with 1.5% versus MSCI World, lowest level since November, and the 2nd percentile versus the past 5 years. Yeah, so 13Fs, when they come out, that's where a lot of people go to data. And so GS equity, fundamental, long, short performance estimate. Yeah, what was interesting is that essentially what they're saying is that everyone was short and losing their ass over the last 4 to 5 weeks, which is interesting. Max pain levels for hedge fund sector, yeah. What's interesting is for a while the retail investor was doing better than your typical hedge fund. I don't think that's always the case, and hedge funds, it's in their best interest to win, and there's more of them with more money than of you. with your money because they collude together and you don't. But I think this is interesting because now that we're starting to see pullback, maybe some of these positions are actually starting to go into profits. But how I ended this email is really just this could go one of two different ways. Is that it's either going to create a short squeeze, we're going to have Wall Street bets kind of reactivate, sniff this out, catch wind of this, these 13F filings, and put this data together, or see this data that you're seeing in front of you. And what that'll cause is a melt up because they're trying to squeeze out the shorts. And maybe it represents that they're going to get it right, and the stock market is going to start to see some lows. And this is the 18th, and then we see the crypto bloodbath on 22nd, 23rd. We saw legacy markets pulling back on those days, so it turned out that there was no short squeeze. That's how that played out. So second thing I want to kind of pivot into now is some older, this is seeming like older data from Goldman talking about hedge fund positioning, but the most popular hedge fund long positions have struggled in the past few months. So this is talking about how much they were struggling in Q1 of 2021 being long. So they longed at the wrong time, and they shorted maybe a bit early, but I think some of them are definitely going to be in profit now. But interesting data to say the least, so I'll kind of slow scroll through this so that you can see it. Okay, sec level, Infotech, right? FAAMG, Q1. That's FB, Amazon, Apple, Microsoft, Google. Okay. And then, this is by far the best one, is year-to-date performance of the most popular long positions, most concentrated short positions by sector, is you see that short positions are drowning out longs. Energy, financial, material were the biggest longs. And so they clearly missed the whole inflation play that just played out. Okay, and then here's another piece to back that up, where most people are shorting Tesla, is because we see 50 stocks that represent the largest short positions, and the largest one is Tesla, right at top. So there is a lot of money short Tesla right now, once again, which he does not like. Another interesting thing that, I don't know who pointed this out, I think this is Bloomberg, S&P and margin debt move lockstep. So basically, this is pretty interesting too. I think this is Bloomberg that pointed this out. So the correlation between debt and the S&P performance. So essentially, margin debt and the S&P is essentially moved in lockstep. So what that means is that you need more money printing for the S&P to go up. And this is over the last 50 years, but I mean, the 100-year chart is something that I show pretty often. And the 100-year chart is, even though you've got these 30-40% pullbacks that you see here, these recessions that you see here, is predominantly the thing that goes up, okay? And I don't see that stopping anytime soon. So now let's kind of pivot into the more important stuff, which is what's going on with this money printing, what's going on with the repo markets, and what's going to happen when the Fed starts to taper QE off. So essentially what's happened is 40% of the money supply was created in the last year, which is a problem because if this was like a crypto, this was a shitcoin, I mean, the statistics for the US dollar are bad. It makes it look like a shitcoin. Let me pull this up here in the background real quick. Yeah, I saw this shared with me today. So 27 trillion in circulation, unlimited supply cap, only one node, 25% of supply minted in the last 6 months, 1% of holders own 30%. That's the US dollar. But if you read those statistics and you thought it was an altcoin or a crypto project, you'd think, gosh, that's a pretty crappy project. Why would I want to get involved in that? And so we have what's going on is essentially a hidden tax. Inflation is a hidden tax. So they knew that they couldn't, raise taxes because that's like death for any kind of politician. So what they did instead is they just said, okay, well, we're gonna do all these stimulus and get this money out to you, and we're gonna do it through printing money. So they could have done it other ways. They could have, changed the Pentagon budget. They could have, made changes there. They could have, forgotten about a lot of this Green Deal, which is mostly bullshit, and focus those funds somewhere else. But instead they decided, no, we're just going to print this money out of thin air, which jacks up the money supply. And what starts to happen with that is, first it goes out, and there was a record high 33% savings rate. I don't know if you remember this, in March to April of 2020. because everyone had thrown that money into the stock market. Well, now, you got people getting rich off Doge, you got people getting rich off Tesla up in this last year. And so now that money starts to come out, and because you had everyone not building for 6 months, 12 months, however you want to say it, is there's supply chain issues now. So they weren't cutting down trees for lumber. They weren't, tending to their crops the same way that they were. We were on restricted amount of work time, running skeleton crews in these companies. So now you have all this demand and not enough supply because of what just happened over the last 12 months. And so it obviously can't catch up. So what happens is people start spending, and then they spend more because they want it now, and I want the graphics card now for my computer, and so we pay double, we pay triple. I want the PlayStation 5 now, I want the Xbox One now, so I go pay the scalp or double. All these things start to happen, and before you know it, you see record high inflation happening, which they're claiming is going to be somewhere at like 6.4% for the year, but I don't think, 4.6%. Is what consumers are expecting, but I don't think that's going to be entirely accurate, and it's not accurate in terms of certain sectors. We're saying 40%, 50%, 60%, and beyond. Okay, so overall, consumer sentiment is starting to wane and be lower because of inflation expectations. So I want to get into this part of it as well in just a sec. But so yeah, essentially the Fed is just printed, Fed Treasury in lockstep has printed all this money, and if we look at the Fed's balance sheet, they are buying stocks, they're buying treasuries, they're buying bonds, they're buying everything. They're buying everything they can to just kind of keep this thing afloat. And so this is really interesting from Kaplan, the Fed's Kaplan. And so this is really, really interesting. What I want to share with you is this guy, Zoltan. I've been following him for a while. He kind of turned into the repo expert. So what's happening with the repo market right now is there's astronomical use of it. And so how he describes it is simple. The Fed is taking treasuries out of the market through QE purchases and putting them right back in via the overnight repo markets and the 30-day settled repo markets. And if we look at our volume here, we are seeing record high volumes. Now, here's the deal. They have laid out for us the taper of QE that they want to do, essentially telling us that they want to slowly start to, wane this out and taper this off. But the problem with this is that this whole model right here and what they're telling us is still equivalent to about $1 trillion that they want to essentially print and quantitative ease or print in and pump into the markets. So the inflation issue, even though lumber's kind of come back down, material costs has kind of come back down in terms of the stock price, the ETF prices, I really don't think that you're going to see these just completely come back down to where they were. And the answer is very simple. If you go and start paying somebody $15 an hour, can you reverse that? Can you stop that? Can we roll back, minimum wage? And can we roll back these inflated wages to get people to now come and do regular jobs because the unemployment was too enticing and they didn't want to work? Can we roll that back? No. Short answer is no, you can't roll that back. It doesn't take an expert to figure that out. So, this is a huge question mark and could actually create a deflationary environment short term, or we could see to where as kind of things blow off top, like what we just saw, what will be interesting is to see what happens next. We might get a little pocket of deflation, but then another hyperinflation, pocket of deflation, or it might just be that, that was it, and then we get this big rug pull, and we get this huge deflation that creeps in. And, how many of those, really, of that cycle do you need before utter, total confidence in the U.S. dollar is broken? And the confidence in the U.S. dollar actually isn't as high as people think it is right now. So anyways, what else does he say? Use of the facility has never been this high outside of quarter end turns. And the fact that they use the facility, the fact that the use of the facility is this high on a sunny day mid-quarter means that banks don't have the balance sheet to warehouse any more reserves at current spread levels. So it's essentially just a way for them to kind of like blend in the money without it actually going to a specific home or a certain home. And clearly, you got credit card companies now really starting to loosen standards. They're basically taking on anybody from some of the articles that I've read. You might not be experiencing this personally based on your credit score or your lendability, but overall, their tightening that they did during the pandemic is gone. And, they are opening the floodgates. Same with mortgages, same with auto loans. So there's they're struggling to now start to use the money because it all is starting to get pumped back in, right? And especially if we see the markets pull back, which we have, and they continue to pull back, people are going to take their money and run and then push that right back into groceries, food, etc., living expenses, and that's going to create, again, another new problem. So let's look at some, I really like a lot of the work that RIA does, Real Investment Advice. They do some really, really great charts. And so here's a look at the velocity of M2 money supply versus all sectors, debt, securities, loans, liability level, and gross domestic product, GDP. So we can kind of compare and contrast those two against each other, okay, and where they met. Recessionary level broken by small business confidence index, which, as I stated, I expected that to be a whole lot lower, okay? And again, this isn't all the way, I don't know when this actually is updated to. I think it was updated to about Q1 of this year, okay? So even though like you got 18 here, like we're into the beginning of 2021 right there, I believe. Okay, what else did I want to show you here? I think that's it. So yeah, we've got a lot of question marks. We're essentially flushing money through the repo markets, trying to hide it because there's so much cash now in the system that there's nowhere to put it. We have inflation happening because people are starting to pull out the savings. The 33% savings rate is gone. People are spending it now, which has clearly led to a lot of the increases in things like computer parts, things like lumber. The average house has gone up $36,000 now in costs. So all of this, there's ramifications for all of this. And what's crazy about it is they're talking about a fourth stimulus check. We have a huge amount of the student debt, even with the bailout that they're proposing, which would, I think, take away $10,000 in student loan debt. There's still a huge amount of student loan debt. Let me pull up that chart. Wait. Here's a look at that. Unpaid federal student loans top $435 billion. But they're only looking to forgive $10,000 in student debt per borrower and ending tuition for many students in public colleges. But that's still a huge amount of money. Even if you wipe that out, that's still sitting there. That's still sitting there on the books. We got more stimulus happening, the green bills, and the variations of whatever might get passed. It looks like the rise in tax isn't going to happen. But if they keep doing it out the back door like this, to where they essentially are just creating the inflationary event and the additional tax through just printing more money, this is going to have a very, very bad effect on the US dollars. Okay, that's all I got for you, my friends. Go ahead and thumbs this video up. It helps get it in better circulation so more of our subscribers get to see it. If you like this sort of thing, then go ahead and subscribe if you're brand new here. Comment below if you got something to say, and be on the lookout. More videos coming soon, my friends. See ya.